Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Genuine Parts Company after it crashed almost 20%. I have it pulled up on CNBC's website here. I have covered this one in the past, so we'll review some of that. I'll let you know what price I would be willing to buy it. I have owned it in the past, and I'll show you how that went. As always, this is not individual investing advice. This is just how I analyze stocks. All right, let's start with fast graphs. I do have a 25% off affiliate link down in the description for fast graphs. If you want to give it a try, see how you like it. They have free trials over there. And if you've never used it before, that link will get you a discount on the price. So, and we're going to use it here in this analysis. Today's decline is not going to be in the fast graph yet. That updates at midnight. So tomorrow they'll have that drop in here and it will show it on the chart. Let's see. So let's go ahead and talk about my history here. So I do have a video out on the channel from 8 months ago that someone had requested for GPC. I always want to say that and invert the letters for some reason. But today, after this crash, I thought I would take another look at it. I've done well with this one in the past. So I bought it in the March 2020 crash, almost right at the bottom. This was the day, I think the last trading day before the bottom trading day, which was the 23rd. And then held it for a little over a year, sold for a 130% profit. When I sold it, the price looks like it was about $121 per share. And, that outperformed the S&P 500. It's quite nice. So, great job there. Now, a lot of people would have kept on holding this one. But we can see why. And then I sold it for valuation reasons. It actually went on to have 2 more years of really good growth that I did not have baked into my valuation when I sold it. So they did better than expected, but as you can see, I think I sold what I said it was right about here in mid-June 2021. So the stock is actually lower now than it was then. I think with dividends probably be about flat. So you would have been holding this one for over 3 years with no return, which is one of the reasons why selling makes sense. If you just would have held like even just treasuries, you would have probably gotten about 10% over that time, instead of nothing. Of course, unless you timed the top or predicted the top properly, and you could have sold out at a higher price. But I was using historical earnings growth and not trying to figure out what this boom was going to be. I don't even think I quite realized how big the stimulus boom was going to be when I took profits in this one. But now we're getting to the point where the boom is over. We are in bust area now. Now the stock price has anticipated this off the peak at least, and then earnings are now going to put in a peak right here from last year in 2023 at $9.33 per share. That will be relevant later on. And after the recent earnings announcement, this is where earnings were expected to come in slightly higher this year by 1%. Now, the midpoint of their guidance is $8.10. That's a huge decline, about 20% actually, maybe. From, I think at one point, the expectations might have been up closer to $10. So it's a big difference, and that's why the stock price is crashing. Not only the difference in the earnings decline, but the trajectory that earnings growth is going in the wrong direction. So some of these earnings they probably pulled forward from pandemic stimulus are now turning into a pandemic bust, potentially, at least a downturn, a pullback. And let's get into my valuation here. Well, let's look at the history real quick of earnings. So in the fast graph, you can go back 20 years. So we can go back and look at how cyclical earnings were during the Great Recession, and they weren't too bad. They only declined about 15% over 2 years. Stock price fell about 50%. So the stock price tends to fall more than the earnings. But the market fell about the same amount, right, during that time. So I would say that it's a moderately cyclical business historically, and generally behaves about the same as the wider like S&P 500. let's see. A lot of people own this for the dividend. I want to say when I bought this, I could be a little bit wrong. It was yielding at least 5 or 6% in 2020. I don't know if I can actually tell. Yeah, it won't tell me. Right now, it's yielding about 3%. So it had a pretty high yield, and it was growing at a pretty slow rate. But I didn't buy it for the dividend. But I thought it was interesting. It was one of the few. I think it's a dividend aristocrat, maybe. One of the few dividend stocks that I bought during this time because it was pretty popular. But they had very slow growth going into it, into the COVID decline COVID decline. 2018 had a big earnings growth year, but that's because there were big tax cuts. So this was, if you pull this out when you're doing your earnings growth estimates, you get a much more humble and probably realistic earnings growth metric, which is pretty slow. I think I'm gonna have a 6% estimate now. When I bought it back in 2020, I want to say it was just a little above 5% earnings growth. Now the earnings are declining, it probably will be back down to that historical more 5% level. I haven't adjusted that yet, but that's probably what to expect. It's pretty slow growth, but positive growth. So it's not, this is over the long term. So it's what you want to do usually with businesses like this is buy them very cheap. You want to buy them when they're really cheap. And when the mean reverts or if they get expensive, go ahead and sell them because earnings aren't growing so fast that you'll never usually see a peak stock price again, as we just saw. I sold 3 years ago. Now the stock price is lower than when I sold it. And during that time, I could have invested in the money in anything else rather than have it in something where the risk reward was going to be to the downside. So, that's an important lesson too that especially applies to slower growth businesses. If you have a faster growth business like, Meta or something, which is one that I held through all this, you can justify holding it when it's a little more expensive, more so than a business really isn't going to grow very much. You're just not losing very much when you sell it if the valuation is high. All right, so when to buy this one. So in my last video, both of these two numbers, this is my recession buy price. This is my calculated buy price based on current earnings and historical earnings growth. They were both almost the same at about $100 per share. The recession buy price came down just slightly because I was using peak earnings back when we thought maybe this was going to come in at maybe it was 939 or 930. It was last year when I did this last. So it came in just a little higher than that. Maybe it was 939, a little higher than the 933 here, which is what I'm using now because this isn't going to hit. This is going to fail. So we're going to see the start of an earnings decline. And when I use my recession valuation, I use the peak earnings. So this will be the new peak. I was looking forward before at what that might be, and that's going to fail. So we're going to be left with this $9.33, which is just slightly lower than what I was using before. But that's the reason why the buy price is now $97 instead of $100 using the recession method, which I'll cover briefly in just a second. Now the normal valuation method, because earnings are falling, so I'm using $8.10 now instead of, let me scroll over here and I'll move my head down. So this is analyst earnings growth estimates. This was like $9 and something. Now it's only $8.10 was the midpoint. So because this base has come down from where I calculate earnings growth, I left my earnings growth rate the same at 6%, 6.14%. Because this has come down, that means that the buy price has come down because the base from which earnings start growing that you can collect over time is lower. They aren't earning the same amount of money, so the business isn't going to be worth the same amount over a 10-year period, even if earnings growth is the same. So this has been lowered 20%, which unironically is about what the stock is down today. So the market is using a similar valuation I am for what I would call like a fair value estimate. I'm trying to buy it cheaper than fair value because it's a slow growth stock and I want to be able to make a big return, maybe not 130% like I was able to do last time, but a good return and with lowering my risk. So I actually want to buy it, I would want to buy it about 30% lower than fair value, which is probably what the market has it priced at right now. And that would be about $79 a share. Now what happens is, and a lot of people can be confused by this, is if a business's earnings and price aren't super cyclical during previous recessions, which is where I take this number from. So this comes from the 2008 recession, okay? If they aren't super cyclical, then you can buy, when earnings are falling, this actually becomes the higher price. The recession buy price becomes the higher price. They were the same, but if earnings come in even lower next year, the normal buy price will get lower with it. Well, if you keep doing that, then you never end up buying a stock if it ultimately recovers. So what this recession buy price has built into it is the expectation that earnings will recover within, a couple years or something like that. In a similar way that they've done in the past. So if you look at 2019, earnings recovered in 2 years. We'll go back to 2008 and we'll see how long it took. So it looks, just eyeballing it, we had 2 years down and then the next year. So it took about 3 years for earnings to recover. So embedded into this recession buy price is the idea that there will be a recovery and that the market, but what happens is when earnings start falling, like they just did in this report, the market will keep getting like negative and negative and negative, and it really won't get positive until, some stocks they anticipate a little bit ahead of time, but it really won't get positive until those earnings come up, and then the stock will rocket, and you'll never get a chance to like buy it cheap, like at the very bottom, which is what I did last time. So now this isn't guaranteed to like get at the very bottom, but it gives you a place to start buying while everybody else is negative and the numbers are negative and everything's bad. So if you're doing it on a math basis, like the market's really doing right now, they'll start projecting everything to go down like in a straight line for a long time. Whereas if you think, okay, yeah, maybe we'll have a recession, maybe there'll be a pullback, but 3 years from now it'll recover. What would be a good reasonable price to buy then? Well, then this $97 would be the place to come in. So the way I do that is I take the peak earnings of 2008, and this is basically how I bought it in 2020 near the bottom. It just happened to be near the bottom. There's several stocks that got close that I didn't buy, and there's some that I bought sooner that kept falling. So, but it gives you a good estimate to use, and at least a ballpark figure. You take peak earnings and then you take the low price. So low price was like $25, we'll call it $25 a share. Peak earnings was $2.98 back in 2007. You create a recession PE out of that. So when I did that for Genuine Parts Company, that came out to like a 10 recession PE. And then usually I add some kind of a buffer to it. So in this case, I added 30% to it because that's like the worst. That's like the worst that it got in 2009. And so I don't expect everything to always, I'm not trying to pick the exact bottom necessarily. I just want to not buy too early, right? Like the folks that bought the stock in the past 2 years bought too early, basically. So it really just helps you from buying too early, and it also keeps you from getting too pessimistic when everything is bad and you assume eventually it will recover. So that $97 should stand as a good spot to start buying. And then if you want to take out the buffer, you can kind of give yourself a range. So if I get rid of that 30% and I just go with, because this is using peak earnings, that 933 that I showed you earlier from last year. So the current earnings can go horribly negative, and this isn't going to change. I'm going to keep using it. And that's the trick for kind of going against the market. So that would bring it down to about $75. So in between, let's just call it $75 and $100 a share. That's a good range to start building, whatever kind of position that you want to build. This stock tends to attract a lot of different people because, like I said, I think it is like a dividend aristocrat or popular dividend stock. It does have a little bit of cyclicality to it, and it's definitely tied to the industrial economy and the wider economy. So if you get it just right, you can do really well with it, but you can't get too well. You can hold it for a long time, but it's one of those where if it gets overvalued and you own it, you might as well just take profits, because they're not going to start all of a sudden growing at like a really sustainable fast rate. It's just not going to happen. You're much more likely that they barely grow at all for a while, which we've seen that happen in the past. So hopefully that gives you, I don't know if I explained all that the best, but I mean, hopefully that if you watch some of my other videos, it will make more sense. But hopefully that gives you a place to aim for in terms of when to start buying. And then once the recession's over or downturn's over, and if it's just an industry downturn or whatever, then you can go back to using this type of valuation to figure out when to sell the stock or buy, sell, hold the stock. But you want earnings to be on the uptrend at that point. So there you go. Little analysis for Genuine Parts Company to replace my other one. And if you enjoyed this video or you found it useful, hit the subscribe button, hit the like button. If you have a request, this one did not come in by request this time. I'm just making it because it crashed today. But if you have a request, let me know. I'll get that ticker on the whiteboard behind me. Eventually I'll make a video. And make sure to check out Patreon. I have a free tier over there for stocks that aren't in the S&P 500 that I get requests for at just $5 a month. You can request that I post those videos on Patreon. And then I also have a $25 tier weekly pick over on Patreon for people who are like dollar cost averaging. A lot of times the feedback I get is my buy prices are too low and they'll never hit. So if that's the only thing holding you back, I force myself to pick the best relative value each week with those weekly picks. Thanks for watching. See everybody later.